Global equity markets were effectively unchanged in the final quarter of 2024, with the MSCI World Index losing about 0.2% in dollars. Overall, 2024 was another good year to be an equity investor, with global stock markets up nearly 19%. The fourth quarter of last year was essentially characterized by US exceptionalism, rising bond yields, and Donald Trump's election victory. The US Federal Reserve followed up its initial 0.5% rate cut in September with two more 0.25% cuts in November and December, which really was very much in line with the market's expectations. What we saw late in the quarter and into January this year was that healthy economic data and sticky inflation really drove down expectations for more rate cuts this year. That then put upward pressure on bond yields through the final quarter of last year and a little bit into this year as well. The US election, in which the Republicans gained control of the presidency as well as the Senate and the Congress, is in line with expectations, making it easier to implement bolder policy actions in the US. And given Trump's style, which we know from his first term in the White House, we do expect volatility to be a key theme this year. Trump's threats of implementing tariffs on trading partners, an outperforming US economy, and higher interest rate expectations all created a backdrop for a stronger US dollar last year, and that currency rose about 7.5% against the basket of its peers in the fourth quarter. US exceptionalism, we think, will probably continue into 2025, but the question really is whether this is already reflected in relative valuations of US stocks and the dollar compared to global peers. Following strong gains in the US equity market over the last 2 years and extended investor positioning, we wouldn't be surprised to see some weakness in the short term, especially as the market recalibrates for higher bond yields and of course digests the potential impact of Trump's trade and immigration policies. Having said that though, with US economic activity still quite healthy, private sector balance sheets that are generally in good shape, and a bottoming of the inventory and credit cycles, company earnings growth should really accelerate in 2025. That in itself should then provide something of an underpin to equity valuations. The South African situation deteriorated slightly over the fourth quarter, with the dollar strength that I mentioned earlier driving the rand somewhat weaker. Also, our status as a small open economy really hasn't been helped by the rhetoric coming out of the White House. South Africa's position as the little s at the end of the BRICS grouping does mean that we're viewed as more aligned with China, and that does put us in a more complex position from a political perspective. But regardless of the global situation, we think that the key challenge for South Africa remains converting that positive post-election sentiment we saw last year into actual reforms and real improvements in economic growth. Moving to asset class performance, US stocks again dominated the final quarter of last year as well as the year as a whole. The S&P 500 and NASDAQ indices were up around 2.5% and more than 6% respectively in the fourth quarter and north of 25% for the year as a whole. European stocks fell 9% in dollar terms in Q4 to be up only about 4% for the year, while emerging markets gave back their third quarter gains, falling around 8% in dollars in the final quarter to be up 8% for 2024 overall. From a style perspective, the growth factor performed best, rising nearly 4% over the fourth quarter. By contrast, quality and value factors lagged, falling 3 to 4% in Q4 as markets really focused on what a Trump presidency would entail. When looking at sectors, consumer discretionary, tech and financials did well in the fourth quarter on the back of lower expected regulation given the Trump presidency. They were up about 4 to 9%, while mining shares globally dropped about 19% and healthcare fell 11%. Energy stocks fell 5% over the quarter. Tech and financials were certainly the winners for the year, up 33% and 28% respectively. Global bonds had a poor final quarter of last year, falling 5% to be down about 2% for the year as a whole. The yield on 10-year US Treasury bonds rose nearly 80 basis points in the fourth quarter, its biggest quarterly jump for a few years now. In our last video, we noted our concerns around global bonds, given that we thought the market had priced in more interest rate cuts than we viewed as likely. And the market's rate expectations have now adjusted, and we really see a much more balanced risk-reward environment for bonds going forward. In the commodity space, oil was up about 4% through the fourth quarter, while gold took a breather and was essentially flat, despite both a stronger dollar and higher bond yields. Really, around gold, we expect it to trade more as a geopolitical risk hedge going forward, and thus it will probably be less sensitive to interest rate changes than it was on a historical basis. When we look at South Africa, the rand gave back around 9% in the fourth quarter, leaving it close to flat for 2024 as a whole. Our base case is for the rand to appreciate somewhat over the coming months once some of the political noise subsides. Our local equity market had a tougher fourth quarter, falling 11% in dollar terms and 2% in rand terms. For the year as a whole, the 13.5% rand return from our local equity market was about in line with expectations and certainly quite comfortably ahead of most of its emerging market peers. Within our market, resource stocks were the key laggards over the fourth quarter. Our local bond market was flat over the quarter, but for the full year, South African bonds gave you 17% in rands or 13% in dollars, which was well ahead of global peers. Our house view equity model's performance over 2024 was encouraging in absolute terms, delivering a little over 11%. Over the last 5 years, this portfolio has returned nearly 12% per year after fees. That's more than 7% a year ahead of inflation and about 2% per year ahead of the average peer. In 2024, our exposure to Pepkor and British American Tobacco certainly helped our performance, while holding Sasol acted as a bit of a drag, as did the fact that we didn't own Capitec. The Sanlam Private Wealth Equity Fund remains in the top quartile of its peer group over both 5 and 10 years. Our worldwide equity portfolio lagged its benchmark a little bit in 2024, really driven by those narrow global markets. So while this portfolio has quite good exposure to growth via businesses like Google, Microsoft, SAP, and others, in general its positioning is tilted a little bit more towards defensive names. We're certainly encouraged, though, by the improved performance over the second half of last year of the largest building block there, which is the Sanlam Global High Quality Fund. If we then move across to our Regulation 28 multi-asset portfolios, the short-term performance was a little disappointing. The balanced, moderate, and conservative balanced portfolios were all a little bit behind their benchmarks for the year after fees, although performance did recover quite nicely in the fourth quarter. Far more importantly, though, we look long-term, and these portfolios are either in line mostly ahead of their benchmarks over 5 years, and over that period, they've delivered 5 to 6% above inflation. In terms of activity within the portfolios in the fourth quarter, we participated in the Boxer IPO that was in November. That's a business that we expect to deliver strong growth for a number of years, and we're quite happy to own that. And then after our Pepkor holding had performed very well in the second half, we took some profits on that name in mid-December and then recycled that capital into First Rand. In balanced and global mandates, we added some US mid-cap exposure ahead of the US election. That's worked quite well. And we also reduced our energy holdings as we expect US energy policy to really drive supply. Overall, our positioning across our portfolios is near neutral at an asset class level, but is slightly conservative within equities. That's given our concerns around valuation for global equities, which is on the expensive side of history. Rising interest rate yields over the last quarter have improved the prospective returns of longer dated bonds, as well as rate-sensitive equities such as listed property and infrastructure, and we probably look to capitalize on those opportunities soon. When we look at global stocks, prices are still well above average on a forward-looking price-to-earnings multiple basis, but only really the US economy is doing well. The market is currently pricing in quite healthy profit growth in 2025, but given political volatility and some upside risks to inflation, we know that sentiment there can change quite rapidly. In South Africa, our market is still attractively priced relative to global peers, although some of the retail stocks certainly got ahead of themselves a little bit in December, which is why we took some profits, as mentioned earlier. Global equities do still look quite expensive relative to bonds as well. The premium that investors are being paid to take the additional risk associated with holding global stocks versus bonds, that remains at about 2-decade lows. So in conclusion, our base case scenario for 2025 is that the supportive macro environment for US stocks continues, and there's a clear potential for a broadening of the market potentially towards more cyclical names. Given high starting valuations, though, we do think, though, that even achieving average returns for US stocks would be quite a good outcome for this year. There will definitely be lots of tariff noise this year, and that does increase some of the tail risks around inflation, especially when you add in Trump's broadly stimulatory economic policies in the mix. So having said all of that, we at Sanlam Private Wealth continue to believe that a diversified approach to risk is essential for proper portfolio construction.